Hi, I'm Gerard Virga, and welcome to the Florida Family Law Attorney Podcast. And I'm here today with Jamie Lima. And Jamie is somebody who's going to speak about a topic near and dear to us. It's the hidden financial mistakes that people make in a divorce that they don't even know that's going to happen. And it looks like it's a fair deal. And then maybe it's not so fair once that financial mistake is discovered or that missed opportunity is discovered. Jamie, you had a career, man. Most people in finance would dream about that. You worked for Morgan Stanley, Fidelity, overseeing over $1 billion in assets. What was it about your own divorce that made you walk away from all of that and dedicate yourself to this work?
Yeah, it was with the school of hard knocks, so to speak, working with, the 20-year career that I've had in financial planning for sure. But, I think it was really just my own experience in my own divorce, right? Like I thought that I had all of my financial bases covered. I thought I was going to have all the answers. I thought I was going to handle the negotiations and all the things well, because I had 14, 15 years of experience at that point. And then I realized as soon as I got into it, I realized, wow, this is a lot heavier than I thought. There's a lot more involved than I thought. I'm not really sure how some of these decisions are going to impact me. What is the right decision? And I thought as I was going through that experience, like if I'm having these questions and I have the resources and the education and the hands-on experience at this stage, the average person going through this might be a doctor or a nurse or a firefighter or whatever, probably has a lot more questions and is probably a lot more overwhelmed with it. And that's really what propelled me into this is working towards getting my designation to work in the space and really trying to shift my focus into helping people that are going through a divorce over the course of the last few years.
You're actually a certified divorce financial analyst, correct?
Correct.
Can you tell us a little bit about that, what that means, and how you become one of those?
Yeah, there's a couple different, as far as becoming a CDFA, there's a couple different check boxes, so to speak, that you have to check. The first is education. You have to have a certain level of hands-on experience, a certain level of know-how. It's about a year-long process from the education perspective. So you have to study for, you have to go through all the modules, and there's a study educational program. You have to sit for the exam. You have to pass the exam, and then you can be certified as a divorce financial analyst. And the easiest way to describe a certified divorce financial analyst is think of the average financial planner, the traditional financial planner that all of us, probably have some level of experience with. They help with things like retirement planning and budgeting and cash flow and tax strategies and investment management and all of those things, but with an overlay of helping people make decisions in the here and now relative to the divorce. I tell people all the time, it's kind of the work we do is kind of a marriage between helping you make decisions today relative to things like, how do we divide up the assets? What is the most advantageous way for me to do this? How do I prepare myself for negotiations and settlement with my attorney and all these things? But also, how do those decisions that I'm making today impact me 5, 10, 20 years on to the future? And that's where that old financial planning marriage, so to speak, with the designation comes from.
Jamie, having been on both sides of this as a financial professional and as someone going through a divorce yourself, how much of the financial damage in divorce comes from emotional decision making, and how much do you think that clients separate their emotions from their dollars and cents when they are in a personal situation like this?
I think all of the mistakes, at least in my own divorce, all the financial mistakes came from the emotional side of things. I was not thinking pragmatically and practically. I was not operating like the CFO of my own life at that point, the CEO of my life, which is a lesson learned and something that I try to coach divorcees that are going through this experience now on. Is like, don't step in the same landmines I did. Here's where I made mistakes. Here's where what I would have done differently. This is what I think you should be doing, and trying to help them navigate some of those decisions. And we know this, like we might know with our IQ that a decision is the right one to make, that mathematically the thing that I'm arguing for, or I'm trying to negotiate for in my divorce might make the most sense. But then we have to also operate in the EQ. Our heart tells us something differently. We're in this, in many cases, not so much in the amicable divorces that are out there, which are the minority, as you know, but these litigious, just conflicted divorces that are out there. You're kind of in the center of this tornado, right? You're trying to handle all the things that are going on with the divorce and make decisions there. And you're trying to manage your attorney and the relationship that you have with that person. And you have, maybe probably have kids and a job and all these other responsibilities. And you're just going through this for not a short period of time. It could be 6 months, it could be a year, it could be 3 years in some cases. And it's really tough to stay not, leave the emotion out of it, so to speak.
Yeah, I tell people all the time that emotions and principles, sometimes they get me paid, but they're not good returns on investment. I always try to look at the case as a return on investment. What's the quickest way to get out of the case as far as a fair resolution? If you get bogged down into emotions too much, anger, hostilities, being right for the sake of being right, that can get really expensive in a divorce case. And really, there's no return. And instead of going through the case, looking in the rearview mirror, I tell people to look forward. What do we need to get out of this to get you to life raft, to get you to the next stepping stone in your life, to get you out of this storm? And if you're looking backwards all the time and you can't get past that, you're going to run into something. You can't go forward looking backwards. I totally agree with you. Now, you call them financial landmines or landmines. I call them traps. Can you walk us through, what some of the most common landmines or traps look like for someone who just been served with papers and is about to go through this whole process?
Yeah, I think there's a couple. I mean, the biggest one is, and you know this, when you have been served papers or you decide that you want to get a divorce and you're going to move down this path, you have to operate from the perspective of like everything. We need to maintain the status quo, right? That's the biggest thing. Like, we're not going to open new accounts. We're not going to close accounts. We're not going to move money all over the place. We're not going to, take on new debts and other liabilities and whatnot. We're just going to keep things as they are. And I see people a lot of times without legal guidance and without talking to us first and trying to put a strategy together, they'll take money and they go open this account, or they try to hide the money. And it's just one of those things where it's like you could really set yourself up for not only the optics in the courtroom of what that looks like, but you could set yourself up for the opposite of success in the divorce if you're doing those things. And I think the second one, really, to be honest, is taxes. People think that they're just going to go through this, they're going to divide up things, and they're going to just, you're going to keep this and I'm going to keep that, and we'll just separate things and move on with our lives. But they don't really look at the tax impact of some of those decisions. And they get that the taxes can come back and haunt you, not necessarily from a tax liability in the here and now. Nobody's saying take all of your money out of your 401k, cash out and pay this gigantic tax bill. But 5, 10, 20 years on down the line, maybe you want to retire and you think you're going to be able to access this money to be able to support yourself later. And you realize, wait, whoa, I have a bunch of taxes I have to pay on some of these distributions and whatnot. Not planning accordingly and not factoring how taxes come into play can be a real problem.
Yeah, absolutely. In almost every one of our agreements that we have, it says in there that we're divorce attorneys, we're not CPAs, we're not tax experts, and we advise you to go speak to a CPA or a tax attorney because there are so many wild cards that can happen, especially down the road after the agreement's signed, as far as tax liabilities are concerned. That we tell everybody you need to go get that professional opinion and advice on those issues, and really get somebody who can guide you through, because a very fair agreement can become very unfair quickly when sometimes tax considerations come into play. So those are two excellent points. What one thing I want to touch on too is you were talking about after filing, moving things around, opening up new accounts, clearing out accounts, pulling out retirements. I mean, those can be considered dissipations, which almost every court I have been lucky enough to practice in has a standing order that says you're not supposed to behave that way. The equitable distribution statute in Florida creates a grounds for an unequal distribution if you dissipate assets. In addition to that, I will tell you that if you hire someone like Jamie, or you get a forensic accountant and your lawyer, and we have to start tracing where you moved the money, where it went, what account it went to, where it came from, those are all exercises that will have to be performed, and they're also costly because it eats up attorney's fees, accounting time, expert time, and resources that we're not really using to solve the problem. We're just trying to explain, which way the knot got tied, as opposed to, really trying to figure out how to untie it and get you moving forwards. I caution people about that, and I think that is another big trap. And one of the things I see in my practice all the time is that people focus on winning the battle over a particular asset without understanding what that asset is actually worth to them long term. A house, a retirement account, a business interest, they're not all created equal. How do you help clients think about asset division in a way that goes beyond just splitting things down the middle and really looking at their true values?
It goes back to my comment about the taxes, right? This is a perfect example of it where if you let's just say the average, situation is I have $500,000 in equity in my home and I have $500,000 in my retirement account. We see this all the time where the couple's like, well, that's an easy fix. I want to keep the house. So let me just keep the house. You want to go do whatever you want to do. Why don't you keep your retirement account and move on with your life? And everybody's like, okay, easy. Well, not so fast because you have tax benefits of keeping the home. You have capital gains rates that are involved that are a lot lower than ordinary income rates that we all pay in our W-2 employment and what have you. But you also have, if you take the retirement account and you take distributions out of the retirement account, especially before the age of 59 and a half, where you're going to be penalized for taking distributions out, you could be in the 30, 40, 50% tax bracket, depending on what state you live in and what kind of other income you have coming in. And so that $500,000 home equity example and the $500,000 retirement account example, they're not equal because this account over here might only really be worth 250 or 300,000 and the house is worth significantly more because of the appreciation and the tax benefits that you have on the other side. Knowing all of these little intricacies and nuances is incredibly important when you're starting to think about settlement.
Yeah, I think that goes to the point of really you got to factor in the tax impact. And I think, my understanding, whether you're working with an accountant, certified divorce financial analyst, I tell people a lot of times you guys are looking forward much further into the future, as to 5 or 10 years from now when I need to pull this money out or when I go to sell this house, what are the liabilities looking like then? What are the landmines, as you call them, that aren't here today, but they're going to be, a mile or two up the path, and trying to go ahead and get those out of the way and get those accounted for. Because again, a deal can look very, very fair on its face. It's like your hypothetical. But then when you really kind of move down the road a little bit and get a little perspective and look at it from far away, it's not fair at all. So those are, things that I think that a lot of times clients really struggle with. I've been working on a case recently where, I've been saying for a while, we really need to look at the tax implications. And they kept negotiating amicably and, have an agreement that they're, close to inking or thought they were. And I had to stop and put the kibosh down and say, hey, look, again, this doesn't seem very fair to me. I can't account for who paid taxes on this money. I don't know when we take, buildings out of LLCs and start distributing them to people, what the taxes are on that or what liability is going to get triggered. We really need to get a professional in there to do a little bit of an analysis on this because it may look even on its face. It's probably not even when we really distribute it. So I think that's, very critical. One of my favorite stories early on, and I was practicing and probably at my first or second year being a lawyer, and we're in the settlement conference and it's been going on, man, for 4 hours, 4 or 5 hours. And we've gone over, past 5 o'clock and we're fighting over this table. And it just, this is the last sticking point, this table. And I remember, hey, I need some motivation to keep going. Is this table like, is it your grandmother's? Did it come over on the Mayflower? Is it mahogany? Like, give me something, like this is, and I never will forget, it was $90 table from Walmart. And, I'm doing the math on the 2 or 3 hours that we've spent arguing about it. And I think that really put it in perspective for me early on. We can be right and you can fight to be right, but it's a very expensive fight. And what's the return on investment? And that's a circumstance, a $90 table. I remember, telling the client I'll reduce the bill by 15 or 20 minutes. Don't tell my boss and go buy yourself another $90 table. And let's seal this deal and get it behind us. But yeah, being right can be very expensive, if it's not, not backed up by really reasonable logical thinking about what is the return on this. So let's talk about, hidden costs for a minute. What are the financial mistakes that quietly cost families real money during the divorce that most people and even some attorneys might overlook?
Well, I mean, you nailed it with the $90 Walmart table. You see that happen all the time. It's like, what kind of, do we really want to die on this hill over a $90 table? Come on, but I think the one I see all the time, and you and I talked about this as we were, kind of preparing for our conversation here today. It's relying on the attorney to do all the work, right? Like, I mean, you're amazing at what you do. You have a ton of experience doing this. And a lot of the attorneys that we work with are in the same camp where they, they're very well educated. They have been doing this work for a long time and they know the law, but they're not the financial experts. And even in my own particular case, like I gave you the example early on, in my situation, I just said, handle it all. I called my attorney, paid my retainer, and I figured he was going to handle everything. And that's a mistake that I see a lot of people, not everybody, but a lot of people make that same mistake where they're like, oh, my attorney is going to be able to help me figure out how to divide things up. My attorney is going to understand the tax consequences of these decisions and so on. And it's just not like, I would never claim to be a legal expert. I would refer to you. You don't claim to be a financial expert. You would defer to me. And that's how that symbiotic relationship between attorneys and CDFAs should work. But a lot of people just put so much weight into having their attorney handle everything. And maybe they think it's like, well, I can barely afford my attorney, let alone hiring a financial planner. What I think, at least in my experience, and maybe you could share yours as well, but in my experience is when you have two parties, two professionals that are working cohesively together and collaborating on a case together, I stay in my financial lane and you stay in your legal lane, we can usually get the client through the case with their finances intact, number one, and in a much better financial situation later on, but also keeping more money in their pocket during the case because we have the specialist being much more effective and efficient in their space.
I totally agree with you. An analogy I use to a lot of clients who don't really understand that concept is I tell them I could probably frame you a wall. It will probably take me all weekend, and I don't even know if it'll be square or sturdy. I can get it done, but if we have a framer in here, a carpenter, they're going to knock that out in about 15 or 20 minutes and be about their way. And if you're paying, lawyers' fees to do some of these calculations that they're not comfortable with, or they're going to take them an exuberant amount of time, you might be better off paying the financial person to do the calculation. Then they're going to do it they know it like the back of their hand. They're going to knock it out and be done in about 10 or 15 minutes and, kind of get you the answers you need. Because what a lot of people, forget in these cases is, time is money. And the more hours the lawyer spends on the case and the longer you're in litigation and the more fighting occurs and depositions and subpoenas and all those fun things that are part of the litigation process, they all come with a price tag. So, one of my favorite things to do in a case, if everybody will allow it, and the parties are emotionally intelligent enough to realize this is the right thing to do, is I get an accountant or someone who really understands their finances, might bring, someone like you in to look at their investments, their retirements, and get some expert eyes on this and figure out this is what the marital estate is. This is how the knot was tied. This is, how everything's entangled. What's the best way to untangle it the quickest and the most cost effective manner? Get everybody their fair share according to law because, it's equitable distribution. That means fair. But realistically, the vast majority of the time means equal. And then, how can we do it in a manner that makes the most sense to mitigate taxes and other expenses so that we get the parties their money and their money's not burned up in taxes or other expenses down the road. And I totally, think that is the best way to handle a case when the parties and the other attorney on their side will allow it. And I tell people all the time, like when I suggest that, I'm not suggesting an expense. I'm actually suggesting that you take some of the money that you are probably going to end up paying me and redirect it to something that might be even more fruitful because my job is to argue, to be adversarial, to object, and to advise you as to the law. Sometimes having in some cases, I've seen people have agreed to like a neutral financial, kind of person that, kind of just guides everybody and, at least gives them their opinion. They may stipulate that the person can't testify or whatever, and then try to get them through the process. Cause I might even make a suggestion and be acting in 100% good faith and may see an idea of how to untangle this knot. And inevitably, the other attorney and the other side's going to say, "Oh, we're not listening to your attorney," and because they assume that my job is to to get my client the best deal possible, and that's true. But it may be something that makes common sense to everybody, but it's just not going to be agreeable because I suggested it. So I think that's another thing that can really, really that you guys can bring to the table. Now, let's talk a minute about retirement accounts. Retirement accounts are usually one of the largest assets on the table in a divorce. And I think a lot of people don't fully understand what happens when you divide a 401k or a pension through a quadro. Can you break that down, the financial pitfalls around retirement accounts, division, taxes and what people really need to watch out for when they're doing that?
Yeah, quadros are a little bit more complicated than people think, as you are well aware. So I guess starting from the beginning, a quadro or a qualified domestic relations order is a document, a legal document that someone like yourself or other drafting services will draft. I would say towards the tail end of most divorces, right? Once you kind of have the framework for agreement, who's going to get what, that's the ideal time to start putting that document in place. And the beauty of doing that at around that time is, and I guess let's talk through the mechanics of this and I'll come back to that. But the document is drafted with the terms of the agreement, who's going to get what and then what percentages of say a 401k plan at Fidelity Investments, right? That the parties come to an agreement, that document is drafted, and the document is sent off to the plan sponsor, i.e. Fidelity in this particular case, for review and approval, which turns it from a domestic relations order to a qualified domestic relations order. That document then comes back to us or to you as the attorney. And if we can get that kind of done concurrently with as we're towards the tail end of the divorce, we can package everything together, have the judge sign off on everything all at one place, all at one time. They're going to sign off on the divorce decree. They're going to sign off on the quadro at the same time, saves you some trips and some extra steps along the way, and allows us to take that document then to share it back to Fidelity. Fidelity will split the accounts up, split up the retirement plan based on the terms of that agreement. So in many cases, 50-50. So party A gets their share, party B gets their share, or if they're the employee of that company, they maintain their 401k plan account at the plan sponsor. And the other party, the receiving party, can now decide what they want to do with those retirement assets. So maybe they want to roll them over to an individual retirement account at a brokerage firm of their choice, or maybe they want to do something else with it. So in some cases, people need to take the money out and to maybe put money down on a new home, or to pay a deposit down on a new place that they have to rent, or furnish a new apartment, or whatever. It is at that time that you can leverage the quadro to take that distribution out without the 10% penalty, assuming you're under the age of 59 and a half. You can take a distribution out at that time, subsequent to the divorce and the quadro being in place, and avoid that penalty. And that's effectively how this whole process works, right? So I've seen some pitfalls though, where one of the biggest ones, and you can chime in on this too, is not factoring in the growth or the losses of those accounts while we're waiting for the division of those assets to happen. Or if we're going back to the date of separation. So maybe the date of separation is 2 years prior to when the divorce is finalized. From a financial planning perspective, we want to make sure we're accounting for earnings, dividends, interest, and the like in that account. Because let's just say you say, I'm going to get $250,000 out of this account. Well, you're going to get $250,000 out of this account. If you said, well, I want to get 50% of the account versus a specific dollar amount, the Fidelity in this particular case will split that account up 50-50, including earnings, interest, dividends, and LS, such that was paid to the account at that time. So in some cases, depending on the mathematics of it and how the stock market has gone over the course of the time that we're dealing with, we have to look at that and figure out what is the most advantageous way to divide up those assets by way of the quadro. Because in some cases, you may not want to have the earnings. Maybe you just want to have a snapshot in time, $250,000 cash in your pocket, and that may be in your favor. Or you may want to have factor in earnings and growth. So that's determining how to divide things up and what some of the underlying details, so to speak, are incredibly important to make sure you don't overlook.
Yeah, I think that's a really good point that you brought up because in Florida, the data classification is the data filing. So that's where we start marking, marital versus non-marital, So, if it's from the time you say I do to the time of filing, it's going to be presumed to be marital.
Mm-hmm.
And then we kind of cut off, and start off with that as our date of classification, the filing date, and we kind of look at those values. However, in reality, these cases could take a year or 2 years to really get through the system, depending on how hard people want to fight. And really, I tell people sometimes how fast they come to their senses on, you know, the realities of this is going to get split. So let's, try to do it in the most cost effective manner. But the values may significantly change. And Florida law does give the judge some discretion on valuing it, whether he uses value at the date of filing, a value date closer to the trial or trial date, so you always have to be looking, maybe you want to use the trial or the filing date if the market has went down. Maybe you want to value closer to the trial date or date of trial if the market has gone up. When you're looking at these things, and like you said, the smallest of words and wordsmithing can make a big difference on whether you're getting exact dollar amount or a percentage of what's in there. And sometimes you also have to factor in, sometimes quadros aren't done simultaneously. And if they're not done simultaneously, you might be banking that 50% of this, 50% of 200,000 is 100 grand, but the market has went down or up in that time. And now, maybe the numbers are changing.
Mhm.
All very, very good points that you have to be aware of and be looking at, and all good reasons why you should have somebody with some financial expertise and experience in your corner, to help guide the conversations and to be a source of information for you, and honestly, a source of information for the lawyer.
Yeah.
Um, because I'm going to tell you now, throughout law school, my 3 years of law school, there was no classes on financial planning, financial advisement, budgeting, or retirement, or anything like that. And so thinking your lawyer is Superman and has all these powers and all this information, in a lot of ways, in my opinion, is naive. And I tell my clients, my job in a lot of ways is to be the conductor of the orchestra and to put together the musicians you want to be playing to play the song that you want to hear. Whether it's presenting the evidence, the way you want it, or presenting the hard facts to you. If you're in settlement, and it's my job to guide them and put them together and ask them the right questions and set them down their paths to get us the best information and make them work together as a team. But at the end of the day, it's unethical and it's not going to happen. No lawyer is taking the stand and it's going to testify about your net worth or your retirement accounts, because the lawyer can't be the lawyer and the witness. So at the end of the day, unless you want, and I tell people, most people, have a very limited understanding of the finances that are involved and the complexities of it. And you don't want to really be the only person testifying in your case. You want someone who the judge can look at, in my opinion, and say, hey, this person's credible. They've testified in these matters before. They've been working in this field for years. They've done an analysis on this. They've built schedules. And they're presenting to me, what the lay of the land looks like. I think that's going to be a lot more credible than the litigants themselves trying to explain it, and probably easier to follow, because at the end of the day, when you're putting on a case, you're teaching the judge about that case and the unique factors and things that play in that case. And the simpler, more concise, clean cut approach, is always easier for people to follow and understand. And honestly, I thought this makes for a much more compelling story that the judge will remember. Because I'll tell you, very few times I've talked to an expert and haven't left with, man, I learned something today. And I think judges probably feel the same way. And that's why they're expert witnesses. They're there to kind of educate the court and you, and the positions and what's going on in the case. So from our prior conversations, I'm getting ready for today. You were telling me about some of your experience, and you've worked with a lot of high net worth individuals in complex financial situations. What unique challenges come with that when there's significant wealth on the table, business ownership, stock options, deferred compensation, trust? How does a CDFA challenge the outcome of those cases? And, how do you fit into that?
Well, I think where it starts, frankly, is you kind of alluded to this in the lead up to the question, which is you learn something new every day as an attorney. I'm sure the judges leave the bench and they're like, wow, I had no idea that thing existed, or that's how that worked. And sometimes when you're dealing with these high net worth cases, like I had one case recently, it was $19 million worth of assets, or somewhere in that neighborhood. There were a couple airplanes that were involved. There's multiple LLCs, multiple businesses. It was a lot. And some of it was just like, or just helping paint the picture for what exists in those cases, and helping the attorney and in this particular case, the judge. There was a mediator involved. We didn't get to trial yet, but just helping everybody understand really what's at stake here and how all of these different components are intertwined. Like this LLC owns that LLC. This is a spinoff of that thing. And this airplane it was purchased with these assets, but now it's registered to the LLC. And this is actually how the ownership should probably shake out, so on and so forth. And I learned a ton myself in that case. But we see this happen all the time, especially in these high net worth situations where we've already talked about taxes, so we don't need to go there anymore, but taxes are big. And really it's just a matter of sometimes there's just so much complexity, trying to make it simple for everybody to understand and really just mapping it out and helping everybody understand, like, all right, we take all this information, disseminate it down to maybe even just a one pager to outline where everything is and who owns what. And like, here are the ways that we should be thinking about dividing this up. And in some cases with high net worth cases where you have C corporations and you have these limited family partnerships and irrevocable trusts, sometimes you can't pierce those veils. And it's incredibly challenging to work with them and figure out, like, how do we make this the most fair and equitable division when some of these assets, they may have been established during the relationship, during the marriage, but we really can't do anything with them for whatever legal reasons exist. How do we make sure it's fair on the other side? And is there a buyout structure in place? Is there other assets that are going to be can be used to offset the balance of those the assets that are still in play? So there's a lot of that. And I think you mentioned one thing that people miss all the time in divorce. It's the estate planning piece. Ensuring that you have the proper estate plan in place and your beneficiaries are up to date. And if something happens to you, whether you're going through the divorce, you're still in that phase, or even post-divorce, you want to make sure if something happens to you, your assets get to the right people in the right time, in the right place. And it's very seamless. And people miss this all the time. And I have never seen it happen more than in high net worth cases, where you think that, they're going to have attorneys and they're going to have all these people that are watching out for them and they have all these things going on. And it's often overlooked.
Well, I think, you're spot on with it. The more complicated the finances are, to me, the bigger the team and the more experienced the team you need to really figure it out and to really look at, in some of those circumstances, like you were saying, I think there's going to probably be some significant tax considerations. And then I have even seen where, for instance, the airplane was bought with this money, but then put into the LLC, then the transfers, and there have been certain circumstances where flags were raised on if that was properly accounted for back then on the taxes. And you want to be careful about you know maybe which tree you bark up and what you uncover or how you present it, and trying to not have a tax issue that's retroactive. Something maybe wasn't done correctly, or it's not intentional. It's just that people who have high asset estates and have unique problems that are just not everyday problems. Once the divorce is finalized, a lot of people think the financial work is done. But from what I've seen, that's really when the whole new set of financial decisions begins. What does a smart divorce financial plan look like after the divorce? What should people be thinking about? What I'm really, kind of thinking about here is, let's say the wife and the husband, have significant assets, and significant assets are divided, but the judge doesn't award alimony because the assets are so significant. But the husband's going to continue working in that high earning field. And, the wife in that circumstance may have to really be clever with investing her assets
Mhm.
to make sure she's got enough income to move forward. Or in Florida, we have this little hiccup that alimony cannot create savings. So if your alimony is too much and you're actually able to start socking it away into retirement, that may be a grounds for modification, saying, hey, their need has went down. They're now able to save money and ask for a modification downward of the alimony. How do you work with people post divorce to put together a solid financial plan that, maximizes the assets, the income that they're going to have going forward?
It actually starts at the beginning of the case. And one of the things that we do is we ask everybody to take a beat and they go through what we call our My Priorities worksheet. And my priorities exercise. And we send them a worksheet day one of our engagement. And we review with everybody during one of our first calls together. And my priorities worksheet is very simple. What do I want to have happen with the house if I own one? What do I want to have happen with my major assets? And what do I want to have happen with the kids? Because those tend to be the three buckets that everybody's focused on, and they're some of the most important. So we ask them to outline it, like, what are my priorities in this space? What are my spouse's priorities in these three areas? And just to think strategically about this, like, all right, if I had to coach myself on this, what would this look like? I want this thing and I want that thing, and he wants to keep the house, and I wanted, like, all these things. So we have them go through that, and then we review that during our first call. And once we've established what our main priorities are, that becomes our true north. So every decision we make along the way during the divorce should help us get one step closer to achieving those priorities. Because once the dust settles on the divorce, and now we go into what we call our transition assistance phase, dust settles on the divorce. Now we're like, okay, we went back, let's go back, break out the my priority sheet again, and let's look at what our goals are. Have they changed? Do we need to add others to this list? So on and so forth. And then the real financial planning, future financial planning, traditional financial planning engagement will begin. But having had that conversation in the early phases makes the financial planning need after the divorce, that process, a little bit easier. So we'll help with everybody with handling the quadros. We actually have a drafting team that will actually draft quadros for our clients and work with the plan sponsors and communicate with those teams and so on. We'll make sure the correct accounts are opened up, the transfers are processed correctly. We'll work with the custodians to ensure that if I have to move accounts from Schwab to Fidelity or Vanguard or whatever, we will shepherd them through that process, because it can be overwhelming. You're at the tail end of the divorce. You're trying to, you don't know. Sometimes you don't know which way is up. You're like, all of a sudden you went from being married to being single, and now what? Who has time to call Vanguard and sit on the phone with them for 45 minutes and ask them what the transfer process is?
Right.
We've
And
done
then
it.
what kind of accounts you need to open,
Yeah,
what kind of paperwork you're going to need to provide. Yeah, it can be really overwhelming. And, you know, not to be cheesy, but I'm a big Rocky fan. I think by the end of the case, a lot of people are like Rocky, like circling the ring, barely standing,
100%.
and they're just worn out. And then you have to do all these things in a timely manner. And, again, having somebody in your corner to help walk you through that or to handle it for you, especially when you're dealing with your financial future, is, probably in most cases money well invested. So, we're coming up on the 40-minute mark. But, when we were talking, you told me something really cool. As anybody who knows me knows, I'm kind of a tech AI nerd. I like all things techie. And I like, I like, always speculating about what the future is going to bring us. So I was going to give you an opportunity to tell us a little bit about something called Secure Split that you've been working on, and tell us what that does for people in your field and people in my field, and how that might change the way a lot of things are handled in family law.
Yeah. Well, as you know, a lot of the work that's done on the financial side of things is done with some antiquated tools, antiquated software, and mostly spreadsheets. A lot of the attorneys that I work with will send me a spreadsheet where they've just listed out all the assets. Unless you know macros, tables, and pivot tables, and also what I don't even know, because I don't do any of that. Excel is not my bag, but unless you're an advanced Excel user, it is very difficult to tell a client how taxes are going to impact their situation and how to most fairly divide up the assets and what that actually looks like. And frankly, just creating the family balance sheet that you can use to take that data and put it onto the financial affidavits that you have to provide to the courts in these cases it's so time consuming. So by doing that work for so long in a manual environment, I just grew frustrated with it, where I was like, there has to be a better way of doing this. In traditional financial planning settings, we have software programs like eMoney and Right Capital and Money Guide Pro, already established software programs that are out there that will allow us to do retirement planning and investment management, all those things. But nothing exists in this space in the divorce world. So we've designed, and they're actually launching here relatively soon, Secure Split, which is a platform for divorce professionals to do exactly that. So think of it in this way, where it's, you would wake up in the morning, you log into Secure Split, you can manage your cases, you can upload documents to your clients, or they can download documents on their end. They can connect their accounts to make sure that their financial information is being fed in correctly, and you have the most up-to-date information. And then you can manipulate the information. You can run your alimony calculations, child support calculations, asset division strategies, tax planning, you name it, all in one. So our dream, my vision, and if we can make this happen, which I believe we can, you're going to be able to go in just one place, do all that work, versus having to Frankenstein all of these different pieces of software together in order for you to do your work at the highest and best possible way you can. So if we can save you money from that perspective, we can make your life more effective and efficient, and you can get better outcomes for your clients, we win. And I think it is not a small lift. If you would have told me 5 years ago that I was going to be the CEO of a technology company and we may be launching software, I would have told you were crazy. But here we are. So
Well,
we're going to launch mid-March, and we're going to roll out multiple states per month, every month thereafter. Florida is going to be one of our first next states, so be on the lookout.
one of the things I thought was really unique about it is when you said you link their bank accounts and somehow it gets the feed from the account every day as
Hmm.
to what the most current balance is, or you could tell it, I want to know what the balance was on this particular date, and it would auto feed in from the actual bank or the provider. And I thought that was really pretty neat because we do financial affidavits, which are snapshots in time. Hey, what was it at filing? What is it now? What is it before mediation? Where are we at the hearing? If it could always be up to date, or I could time machine it back to where I needed it, or look at it at varying dates, without really having to do all the legwork. Because as it currently stands, our clients have to download or print out all their statements, give them to us. We then have to go through painstakingly and figure out, what areas we're looking at, what dates and time, um, to do that. And, a lot of times it's a friction point with clients because, again, they think the lawyer does everything. I tell them all the time, I can subpoena the bank for your records, and the bank will gladly send me and you a big bill for probably having to do that, or you can print them out on your own and save yourself money. But I thought that was really, really pretty interesting. But
Yeah.
Jamie, like
And
I told you, go ahead.
no, I was just going to say, and then just to piggyback on that, it's leveraging AI. You mentioned AI, the AI component of this, and these days, if you're launching software and you don't have AI embedded in it, you're probably going to fall flat. So one of the beauty of Secure Split is using AI within the tool. We're going to be able to put you in a position as the divorce professional, where it's like every morning you wake up, you log in, and like here are the top 5 things you need to be doing to move your cases along. Here's the deadline you're up against. Here are the forms that were uploaded last night. You need to review this case, you need to do this thing, and it's going to intelligently tell you what the next best step is so you can manage your cases. And then frankly, leveraging the AI component of it is going to allow you to handle more cases more effectively and efficiently so you can scale your business as a divorce professional. And having the ability, like the financial affidavits, we're going to have this capability here real soon where you're going to be able to, with one click, export that data into the financial affidavits that you've received from the client and send it electronically to the courts for those courts that allow electronic filing of those forms. California, being one of those states that I'm in, allows for that. So we're working on that functionality right now. So there isn't even any printing or emailing or uploading or downloading. It's one click and it's done.
That's really pretty amazing. Well, like I said, when we started our conversation, 45 minutes would fly, and it has. Before we sign off, why don't you tell everybody, if they're looking for some more information about Secure Split or looking for a certified divorce financial analyst that can help them, what's the best way to get in touch with you, and, how they can reach out with questions, or maybe to sample your software.
Easiest thing is just to go to the website. All my contact information is there. You can reach out to our team on the Secure Split side of things to get a demo. If you go to securesplit.com, you can join our wait list. We're taking active wait listers right now. We have about 200 people and individuals and firms that are on the list right now waiting for us to come to their state. So be patient with us. We are prioritizing states as people join the list, and we see those numbers unfold and see where we need to go next. So that's join the wait list there. We'll keep you on our newsletter to make sure you see the updates and rollouts that are coming. We're not going to be spammy and salesy or anything, but we'll make sure we keep you up to date. When it's time for you to get in, we'll certainly let you in. We're going to have MVP access in California. If you're a California divorce professional that wants access to this now, we're taking orders as we speak. As far as the CDFA work and divorce financial planning work, you can find me at allegiantds.com, which is our Allegiant Divorce Solutions website. You book a complimentary call there. My calendar's on the website, so you can see when I'm available to book some time to chat. And there's no harm, no foul in those conversations. If it's a fit, it's a fit. If not, no worries either. I'll try to get you in the right place if it's not a fit for us. But just go to the website. It's easiest place to find me.
Look, we really appreciate you giving us your time today. I know you're a busy man with everything you got going on, and we really do appreciate you. And I'm sure we'll probably bring you back on, and we can kind of see maybe Secure Split in action. And you can kind of walk us through what it does when it's fully operational and available here in Florida. Thank you, and thank everybody who tuned in today. Remember, please like, subscribe, share. We don't do any commercials or advertising. It's just to get good information out to other family law attorneys or people in the community, people going through these tough situations that need information and need guidance. So the best thing you can do to help us is to like, subscribe, share, and help us get it out there. And until next time, you guys out there, take it easy. And we love doing this for everybody out there listening.